Well, those were the big headlines that we are tracking for you on The Money Show and on ET Now this evening. Well, first up, let's introduce now on the show Abhinav Angirish, the founder of investonline.in, to talk about essentially the basics of investing for long-term wealth creation for retail investors. Where do you start off? How do you allocate your assets? We'll talk about all of this. Mr. Angirish, thank you so much for joining us today on ET Now. So let's start off first with the basics. What are the most common mistakes that, retail investors who are just starting off to invest in equities and mutual funds tend to commit?
Hi, Mubina. Thank you for having me here on ET Now. It's a pleasure to be here. To start with basics, a vast majority of investors, especially the young and the inexperienced ones, they generally tend to, chase the hot stocks or the stocks typically where they hear some tips and, this eventually leads to taking unnecessary risks. And also it's believed, that they want to frequently trade and it will yield into higher profits. Both these approaches are very wrong and unstructured, thereby leading to a lot of losses for investors. It's very essential and very prudent to have a long-term view. Without a long-term view, there is no way that investors can make money. There is no shortcut, like they say. It's not going to be very easy to make money in stock markets. So typically, we have seen in the last 8 or 9 months the way markets have moved. People were at home. Record number of demat and trading accounts opened. People have been trading. Markets have supported. But naturally, it's not going to be as easy as it seemed going forward too. So people tend to take higher risks, which eventually leads to a lot of losses. Also what happens is when you have a long-term horizon, it also prepares you to weather the cyclical downturns in the market. In fact, seasoned investors love volatility, right? Because every fall, like a large fall like we saw in March in 2020, was a great opportunity for investors to add. And it also helps you to filter out the noise when you keep checking your portfolio and the perceptions of the portfolio on a regular basis. Also the longevity, why is it so important and why the power of compounding really works over a long term is because I'll give you a very simple example. The government recently announced the Atmanirbhar Bharat theme. Now, many domestic companies are going to benefit from it. Naturally, it's not going to happen overnight, right? It's going to take some time. And these it can take a few years or probably even a decade or maybe even longer. But as and when these companies start benefiting, it eventually adds to your portfolio if you've held on and not, lost your patience. So patience is the key to investing long term, and as long as it gets, better it is because power of compounding really helps. Ideally, your financial advisor is a great friend, and he will keep advising you like a good wife to stick around and not leave the boat midway and keep staying invested as long as you can. That's the basic I would suggest to every retail investor, to just not follow what's happening on a regular basis in the market and don't just see what the Sensex opens in the morning, it closes in the evening. This is short term. Hopefully it stays, but how long it stays, no one knows. And you don't want to be in a situation where you end up saying, oh, I burnt my fingers in the stock markets.
Yeah, absolutely. And, we've seen a lot of that happen really from May onwards, though not necessarily that these investors have burned their fingers because the market, of course, has been in a bull run. And yeah, many of them sort of have got so hooked onto it that, like you mentioned, every morning they check what the Sensex up to, what the Nifty is up to. And that is something they're advising that retail investors don't necessarily have to do, especially when they may not be having the wherewithal of keeping track in the markets on a day-to-day basis. They may be involved in their usual businesses. So do you think that in that case, Mr. Angirish, that it's better off for these investors to invest via mutual funds in equities over, picking shares directly?
See, again, Mubina, it really depends on what kind of expertise you have in the market. If you are an expert, you can read companies and assess companies well. You can understand balance sheets and numbers and what really holds for these companies. Then yes, you can definitely look at investing into equities directly and making your own portfolios. Having said that, mutual fund and equity mutual funds is a great way to also start your portfolio. If you don't have the time, see what's happening. Like I said, in the last 8 or 9 months, there was so much of time on hand. Yes, people did spend time researching companies, researching stocks, researching markets, understanding markets. I know many people and many investors have actually done short courses because they were back at home. But can you now that your work is starting to come back on track, will you have that much time to actually spend in the markets on a regular basis, which we do for a living, right? We do it because that's the work we do. But can you do this not being your mainstream of business? So no, it's not really going to be that easy to do. Hence, equity mutual funds works perfectly for such investors. See, tracking markets daily for retail investor is fine. If you're tracking them just to have knowledge of what really it's what the market really is and where they have gone, is for knowledge sake, it's fantastic. But I have seen that tracking on a regular daily basis typically distorts your long-term view, right? And it tends to influence your judgment. So that's how investors function. If you see I think most successful investors do not at all track markets on a regular basis. It could be once in a while to know what markets are doing. Besides that, it's not a regular basis at all. And mutual fund investments, equity investments, hence are not made for trading purposes. You don't have intraday price movements, price NAVs, and so on. It's basically end of day NAV, because these are long-term investments typically made for wealth creation over a period of time, right? Having said that, yes, you need to track what your portfolio is doing. I would suggest look at it on a quarterly basis to assess how your portfolios are, and not on a regular, not even on a monthly basis. Because like I said, once your view is distorted, you tend to take action. And that action could be emotional, could be sentimental, in whichever way you want to put it. And you tend to time the markets. Once you start trying to time the markets, then God save you, right? Because it's impossible to practically time the market. Trends will keep changing. No one expected markets to be all-time high in the same year when they saw such a dramatic fall of 38, 40% in a month. So these things will keep happening. So those who stayed invested, yes, they have benefited. Those who continued their SIP investments in mutual funds, they did great, and they are reaping the benefits today. Hence, stay invested. Mutual funds, equity funds is a great way to invest. And if you are as seasoned to understand equities individually and to study them, study the markets and balance sheets, then definitely individual stocks is your way to go.
But of course, it's not always about equities. You need to ensure that you have a good mix of, several other asset classes as well. So, Mr. Angirish, yes, create a good equity portfolio for yourself. And, let's assume we're talking about mutual funds right now. But what else do you sort of have to add on?
So, Mubina, see, asset allocation is one of the most important tools which, investors should look at while creating their portfolio. Your asset allocation is derived considering your risk profile, the goals you have, the short-term goals, the long-term goals, and very importantly, like I said, risk profile is very, very essential to build a correct asset allocation, which tells you how your portfolio has to be. Now, there are thumb rules as well, how your asset allocation has to be designed considering your age and goals. But, ideally, these asset allocations cannot be, just a simple mathematical calculation. They keep changing, right? Because your goals will keep changing. Maybe your long-term goals don't, but your short-term goals will keep changing. Your risk tolerance could change once, let's assume a bachelor gets married and he has children, his family comes into play. His risk tolerances will change. His horizon could change if he has certain emergencies and so on. So yes, I believe asset allocation for any investor is most important, utmost important, and you strictly should follow it, because that will give you good sleep at night and unless stressing on what others are doing. So what is my allocation will definitely not be for you and for any other investor. We're all different, right? I'll give you another example to just justify what I'm saying. Let's assume there is an investor who wants to create a corpus of, say, 10 lakhs in 10 years. Now, if he's someone of high risk tolerance, we would suggest, invest 85% into equity funds and put 15% into debt funds. Because he has a 10-year horizon, he can take the risk of investing into equities because it's a pretty decent period of time. But again, this person could be a younger person or an older, it doesn't really matter. But if he has the risk tolerance, only then when I can advise him to be into equities, right? If he's someone who has lower risk tolerance, for example, is that a moderate risk? I would say you invest more into debt, let's say 65% into debt and balance 35% into equity. Now, if I'm planning and if this gentleman wants to go by way of SIPs or a monthly investment, his investment will change, because for the person who's having debt, naturally, I'm assuming a much lower return of 6 to 7% on his investment, vis-a-vis an equity of at least 12%. So my investment on a monthly basis can change from 4,500 for the moderate investor, for the aggressive investor, and about 5,500 for the conservative investor because he has to meet the same goal. Again, these categories and these allocations will keep changing. Now, there are also categories where should you invest into gold. Now, suddenly, if you see gold rising, everyone wants to jump into gold. This is where the problem happens because you keep chasing the market on the typical category of investment, which is changing. Like a lot of investors today, I know a lot of retail investors today have moved from debt to equity, even though they know that they don't have the risk profile. If market corrects, the valuation can come down and they lose the asset allocation, and eventually they would blame the markets for it because they didn't want to follow the market. Hence, having a perfect allocation, which you should keep following depending on your goals, is extremely essential.
You've hit the nail right on the head when you mentioned that. Many a times people want to keep switching onto the hot asset of the season or the month, and we're seeing that many people may be wanting to move to equities now, or at least everyone wants to trade in equities. But we are seeing this consistent outflow, by the way, from equity mutual funds. I don't know. Maybe people are thinking of just sort of booking their profits now that the market has rallied so much. But the SAMFI data is indicating as much month after month. Since I think August onwards, we have been seeing net outflows from equity mutual funds. Now, I understand in the beginning that, yes, we had the pandemic, people were facing a cash crunch. So, yes, maybe because of that, they were removing money from the equity mutual fund market. But what about now? Do you think this is the right approach that, okay, the markets are high, so let me, book profits and get out?
Mubina, markets will keep touching new highs, probably lows at times too. But again, this is about timing it, right? Does it mean that if markets have touched a high today, they will never touch a new high tomorrow, or maybe 3 years or 4 years down the line? No, they do, right? We have seen this in the past as well. The recent past being in 2008, when you had a huge correction. The correction lasted almost 15 months, and the market started moving. They had a lull period, and eventually you saw a new high in about 6 or 7 years post that. And from there is here where we stand today. So yes, markets will keep moving. I mean, if you have not started investing and creating your portfolio today, you should do it now. I mean, in fact, as of yesterday, not even now. So yes, you should build your portfolio. Many investors have exited the markets with the fear. See, because what's happened in 2020 is not something which people have witnessed altogether, right? You were at home, you saw a low in the market, and it was anyway a very depressing situation to be in. And at the same time, when you see your money is coming back, the first thing you want to do is you safeguard your money. It's actually when these problems of booking profits happen, even when people didn't need the cash flow at home. There are many advisors who even suggested to book out and stay in cash. But it's always good to have some cash in portfolio. Maybe, again, depends on your risk profile. But if you need it for the opportunity to invest, yes, have the cash. But otherwise, you don't really need to book out, because where these markets will eventually go, no one knows, right? No one can predict. Hence, the concept of long-term investing comes exactly from there. You're not trying to time it because you can't time it. And there are tons of investors I know who exited from August and are sitting on cash, and you've seen the market rise 35% from there. It is genuinely upsetting. I mean, why did I try to be smarter than the market? It's the entire market against me. And there you are. So yes, the exits from mutual funds is a space from the AMFI data, which you see is typically because of this reason. But at the same time, you have foreign investors who are pumping in much more money than what our domestic investors are, which is driving the markets. For all you know, the markets may touch a new high end of the year, or they may not. I'm no one to judge that. But yes, please don't time it. Stay invested, stay your course, maintain your allocation. Very, very importantly. And that's something I'm going on repeating again and again. So yeah.
So stay true to the initial objective for which you were, you started investing, and, you decided to ensure that, you're putting your money in different asset classes. Once that's determined, don't deviate too much. And, all the more, if you are a long-term investor, then there's really no need for you to, look at the markets every day and see that, okay, now, today the Nifty is at a lifetime high and the Sensex is approaching 50,000. So let me just book out profits. That's really not what, mutual funds, like Mr. Angirish is saying, is about. You just have to, and in fact, this was his first basic strategy when it comes to maximizing your returns, being patient. This is the first thing that he mentioned. So I think it all boils down to that really at the end of the day. And on that note, we'll take a very short break, but when we return, we'll take forward our theme of diversification, why it's important to have a good mix of assets in your portfolio, taking cue from Friday's topic of diversification on investing in foreign funds, foreign stocks. We will be bringing on board our Meet Your Fund Manager segment, so don't go anywhere.